First, let's start with the introduction. My name is Giorgio Carlino. I'm one of the founders of Mas4 that is focusing on financial literacy and improving financial literacy at the moment in Italy, but today we have the pleasure to be connected with New York and Steve Malin. Steve, you want to give us like a 60-second introduction about you and your background?
Thank you, Giorgio, and thank you for the kind introduction. Right now, I'm a professor of macroeconomics at the City University of New York. Previously, I was a senior portfolio manager and an asset strategist at two major New York financial services firms. Prior to that, I spent nearly 17 years at the Federal Reserve Bank of New York as an economic advisor and a communications advisor to the president of the New York Fed. I'm an economist by training. I have a PhD in economics, and that's who I am.
Thank you, Steve. I mean, your curriculum is impressive, and I forgot to say that you are, we have been colleagues. You are one of my fondest memory of the time we spent together. I love working with you. My favorite economist anytime. That's like hands on. So thank you again for being here. Today we're going to talk about central banks, and we'll try to give an idea of what they do, why they've been created, what they function in the system, and then of course we'll try to also talk about what's going on right now and why the central banks are once again relevant even in this war time that we're going through. So let's start with the basic. Central banks. Can you give us a bit of history, when they were created and why?
Well, the first really functional central banks, Giorgio, really came about in the 19th century. And they really got their roots to what we see currently actually in England. And the idea was to try to find a way of creating a currency system that would be united, because each bank had the ability to produce its own money. And there were times when countries had as many as 10,000 different money supplies. So the idea was to try to consolidate it into one money supply. And then as technologies changed, the banking systems changed with it. And then it turned out that the banks needed a bank for the banks, meaning they needed different services. And these services would be provided by the central bank. And what that central bank would do would be to try to promote a stable currency, to make sure that in trade, the currencies between different countries didn't have so much volatility that it would affect the flow of gold. Because back then, most countries were on something like a gold standard. And if you had balance of payments deficits, gold would leave your country. And that would create a problem, because the amount of currency that was allowed to be printed was determined by the amount of gold you had. So if gold left, you had less money. So working on a system that would try to consolidate the forms of money that we used, make it functional in a gold standard type setting, provide services to banks, and then allow it to create different forms of payments that we could make, which ultimately led then to a checking account system. That's why central banks were formed. They were very successful in England. In the United States, there were 3 different attempts to make a central bank work, and it really didn't happen until the Federal Reserve was formed in 1913 by law and actually started functioning in 1914, and then other central banks followed.
And you mentioned the relation between the money and gold that we know is not the case anymore. So why the money is still relevant? How can they print all the money they wanted?
Well, all of that comes, Giorgio, with having confidence in the motives and the abilities of your central bank. If you have that kind of confidence, then you're creating what we refer to as a fiat money supply, which has 2 dimensions to it. The first part, which is the bigger part, is that the central bank has nothing to do with the money supply. Actually, the economy creates money on its own. So how does that work? Giorgio makes a deposit. That goes into his bank account. That's money. The bank lends it out to someone else, lends it to Steve. That becomes credit. Steve then takes that money and deposits it in his bank account. Well, now you've seen the money supply grow, because Giorgio still technically has his money. Now Steve has money. So the sense of having deposits, then credit, deposits, then credit, deposits, then credit, gives you the bulk of the money supply. What the central banks do is adjust that magical, uncontrolled way of money supply growth at the margin to add a little bit more, add a little bit less, in order to achieve whatever goals the central bank has. So money grows in a way that mostly has nothing to do with the actions of the central bank, but this fiat money system is controlled at the margin by the central banks. And if you have confidence that they're going to do the right thing, pursue the right goals, then there's no problem. That's not always the case.
Not always the case. And what is their goals and role in the economy in general?
So in the economy, 10 central banks typically have a set number of goals, and it differs from country to country, of course. We'll come to the big one last. First of all, I've already said central banks have to act as a bank for banks. They become the lender of last resort. There becomes a time when banks themselves need to borrow money, and the central bank is there to lend them that money. Number two, the central bank is there to protect the safety and soundness of the banking system and the financial system. That means there's regulation and supervision. A bank examiner once told me that you look at banks as an examiner and you say, banks will do what's inspected, not what's expected. And if you take that kind of philosophy, you watch what the banks do. On an individual basis, you look at what their actions are to make sure they're not doing anything to upset the safety and soundness of the whole financial system and banking system. And then from the top down, you look at the entire banking system and see whether or not it is promoting the economic goals that the central bank might have. Next, central banks are really there as a communications element for all of economic policy. They're there really to build confidence and trust. And sometimes that means confidence and trust, not just in what they do, but what the government might be doing on the fiscal side with taxing and spending. They are a fiscal agent of government. That's very important. And then when it comes down to it, their role is to foster and build confidence, because without confidence, people won't borrow, banks won't lend, and that whole process of growing the money supply won't happen because you need deposits, credit for the money supply to really grow. The big one is monetary policy. And this differs from country to country. In the United States, the central bank has three roles. First is to promote price stability. Secondly is to promote maximum employment. And third is to promote financial stability. The European Central Bank, by contrast, has only one goal, and that is to promote price stability, to keep inflation low, moderate, stable, so it's not going all over the place. That's the big role. That's the one we hear the most about, and it's the one that's most complicated.
Yeah, so it's a very important role. It's delicate and it's complicated because it involves so many parties, and we know there is no simple rule how to fix it. It's not like you have a problem and we fix it. We know we don't know. This is not that simple. It's not one-to-one relation. It's always one-to-many. So you never control the full system, and you try, and that's what the central bank they're trying to do.
Precisely.
So let's before we go into more nowadays what's happening, I would like you to spend a few words about the independence of the central bank. Why the central bank are not part of the government, right? Why we don't elect them directly with the democracy? What's their, why they are independent?
Well, independent central banking is actually a creature of the United States that was then later copied by other countries, Japan, Germany, ultimately, of course, the European Central Bank and many others. The idea is really quite simple, Giorgio. One is theoretical and the other is empirical. Theoretically, think about it this way. Economic cycles are not the same as political cycles. Politicians are always going to be leaning in favor of do whatever you can to keep interest rates low so the economy can grow faster, so we can have more jobs and I can get reelected. And that happens with specific time periods. There are election cycles every 2 years or 4 years or 6. Politicians have to be reelected. But economic cycles don't have that kind of time period. You know, the implementation of monetary policy has lags. They could be long, they could be uncertain, and they can be very variable. And sometimes it could take a long time for monetary policy to actually work. They don't work on election cycles. So by keeping a central bank independent, you're giving them the ability to play out the economic policies that they think are appropriate and have them play out in full without having to worry about election day coming and whether or not people will vote for you because maybe the unemployment rate went up a little bit and they vote against you. That is really the key to the independence. Now, empirically, however, we have found out that country after country after country, the more independent the central bank, the more stable the price level, meaning the most independent central banks tend to be in places that have the most stable inflation rates. And since that's the primary goal pretty much everywhere, that's really critically important. So independence really does matter. And it matters because when you've got that stable inflation, which is associated with the independence, you have stable interest rates, you have more confidence, people are more willing to borrow, lenders are more willing to lend, and your economy grows better. You get more balanced growth in your economy.
We go back to the fact that it has to be credible and reliable as an independent actor in the scene and not seen or perceived as a weapon or an arm in the hands of some political power that wants to achieve something specifically. So the objective of the central bank is, of course, maintain the stability of the system, make sure that the currency the inflation is not too high, and we can grow at the most stable possible way.
Now, one other thing to keep in mind, Giorgio, is that the amount of independence that the central banks have can vary from time to time within the same region or country. For example, in times of crisis, it's more likely that the central bank will be doing things in coordination with the government in order to help solve the crisis. So if you look at it that way, if you say, well, they're working a little bit with the central government, it means that there's a loss of independence. And over time, things become blurry. So if you say, as in the United States, that the goal is to maximize employment while you're also trying to keep price stability, well, the goal of maximum employment typically is a fiscal policy goal, not a monetary policy goal.
Yeah, and that's, I mean, you introduce a big theme like fiscal versus monetary, and that's why the division stands, right? I mean,
that's right.
I remember at the time of Draghi during the big crisis of 12, 13, when he was saying, I'm doing my part, but I need all the states in the European Union to do their part. And that was the, monetary, they were doing the stuff and someone else had to do their contribution to help to solve the crisis.
That's correct. Mm-hmm.
Okay, so now let's go in today time. First, inflation, or let's say at least 10 days ago was the most important news. So what are the central bank doing for inflation, to control the inflation?
I love the word that you just used because I'm about to disagree with it. The word you used was, you said control inflation. The central banks cannot control inflation. Think about it at the current moment. We can't control right now the commodity prices that have been soaring because of the war in Ukraine. Where, think about it this way, if Ukraine produces 20% of all the world's wheat, and Russia produces 25% of the world's wheat, that's 45% of the world's wheat crop that's in jeopardy. There's nothing the Federal Reserve can do about the price of food, or any central bank, about the price of food there. What central banks can do is a little bit more nuanced, and that is to try to set conditions that it considers to be consistent with fighting inflation. And that usually has several dimensions. One is, of course, to control the amount of money in the economy. Control. Now, remember, I started out by saying most of the money in the economy is produced sort of magically by the interaction between deposits in banks and credit. But they can control at the margin how much they choose to add to it or take from it, make the money supply grow faster or slower. That can be adjusted. Number two, they can set policy interest rates, higher or lower. To fight inflation, you typically set policy interest rates higher. Well, that's something that's done regularly. It's something we hold our breath thinking about. But the effectiveness of that is going to vary over time. If you're starting out with negative interest rates and you move the policy rate a little bit higher, it's hard to imagine that one or two moves higher is going to have terribly much of an impact on inflation. So it depends where you start. But adjustment of interest rates matter. Third thing you can do is try to adjust the shape of the so-called yield curve, the relationship between short-term interest rates and longer-term interest rates. And the idea would be, if you allow longer-term interest rates to rise, then that would slow down the demand for things that people borrow money long-term in order to purchase: businesses, homes, things like that, cars. And then that would tamp down demand a little bit, and then maybe you get less inflation. So you have money supply you could adjust. You could adjust policy interest rates. Third, you can take steps to try to influence the flow of credit. You don't want the central bank telling an individual bank, don't lend to Steve, but you can lend to Giorgio. No, you don't want them making those decisions. But you could have them set up a regulatory structure where the kinds of loans they make are more consistent with the safety and soundness of the financial institution in an inflationary environment. And so they do that quite a bit. So the idea is really for central banks to set expectations, because one of the things we know about inflation is that the expectations that we have for inflation get built in not only to interest rates, but into the actions of households and businesses. So communication policy is really important. An example of that will be, if you look at the head of any central bank, if you look at Christine Lagarde, or you look at, say, Jerome Powell in the United States, they're always trying to tell you that, don't worry about it. We've got this under control. We've got the keys to making the inflation rate come down. We're projecting over the next year or two that the inflation rate will moderate. It's not going to get worse. They try to build in confidence that way. And so communication policy becomes critically important.
Yeah, because of course, inflation, it's a lot about expectation. So they're managing the expectation, and that's one of the important role they have. I want to just spend 2 seconds on simplify as much as possible what it means when you increase the rate, right? So when you increase the rate, you make money more expensive, and that's why there is less demand. And so that should participate in calming the economy and reduce the inflation. So that's what, very simplistic way they're trying to do.
And that is so important, because if you go one step below that, there are really not terribly many laws of economics that, no matter when you look at it, it's always true. But one thing that's always true about inflation is that inflation is always caused by a circumstance where the growth in spending over a long time period is greater than the growth of the supply of things for people to buy. Mm-hmm. So if you raise interest rates, you might be taking the growth of spending and shrinking it a little bit, because at higher interest rates, people are borrowing money maybe that is unaffordable to them. They won't borrow. So maybe they don't buy the house. Maybe they don't buy the car. Maybe they don't buy new furniture, or whatever it is they borrow the money to get. And you make the demand growth slower so that it becomes more like what the supply growth is, and then the inflation goes away. And that's why the policy rates are so critical. The policy rates are very, very, very short-term interest rates. In fact, they are the shortest of all interest rates. But they send a signal throughout the entire financial system as to not only what the central bank is thinking, which is, We want demand to slow down. We want other interest rates to go up. And then when those short-term interest rates go up, long-term interest rates also tend to go up over time. And then when those long-term interest rates go up over time, they stifle demand. And when they do that, they start to come down again and the economy is in good shape again. That's the philosophy behind why we raise interest rates, policy rates, as a tool to fight inflation.
And of course, the difficult job is to find the right balance, because the risk is that you raise it too much and then you halt the economy, or you just, create depression or something.
So it's a matter of timing. It's a matter of magnitude, which is what you said, and it's a matter of the pace, meaning, do you raise interest rates every month? Do you raise them every 2 months or 3 months? What's the pace? And then as you do that, what kind of information are you getting from the market as to whether or not it is stifling demand? And as you pointed out so correctly, if you make a mistake and you go too far, you cause the economy to slow down maybe too much. You kill off too much demand, and maybe you even toss the economy into a recession. That's what's so tricky. And one thing we do know about central banks, Giorgio, is that they will always be late. They will recognize the problem before the markets do, meaning they will start to raise rates too late, and they will continue to raise rates too long. And why does that always happen? Because before the central bank will change its policies to either raise the rates or stop raising the rates, they have to be certain. And it takes time to be certain. So the markets have moved, but they need 3 or 4 months worth of data to say, yeah, the market's moved, and that's the correct signal to say, let's stop raising rates. In the meantime, the unemployment rate goes up and the economy weakens.
Yeah, that's normal, and I'm always surprised that people get surprised about this delay that the central bank have it, because they have to wait for the data, and they say that all the time. We're expecting for the data, but then of course we have people making forecasts all the time, and that's the entertaining part of our job also.
Yeah.
So now let's see what is happening in Russia. Is of course dramatic. We were talking before we start this interview that is really dramatic and touching. So what is the financial system, or let's say the first reaction has been through trying to punish Russia through economy. So the central bank play a role in this. How is the central bank play a role in this war?
Well, there are a lot of ways, Giorgio, in which the central banks already are playing a role in sort of stifling the financial system and the banking system of the Russians. Let's just look at a few of them. The Russian central bank makes investments all over the world. And most of the time when they do that, they will deposit rubles, or they will deposit the other currency, maybe euros, at the central bank. And they will say, from time to time, we will ask you to invest this money for us, perhaps in Europe. Well, what happens is that at the command of the central governments, you could freeze those assets, those Russian assets that are there to make investments, so that they no longer can make them, and now they've lost that money. They're frozen inside of the European Central Bank or the Federal Reserve or the Bank of Japan, wherever it might be. So you're freezing those assets. Number two, the main thing that we've been talking about has been that the Russians have been kicked out of the SWIFT system. SWIFT is a communication system that's used to transfer funds and securities between different banks around the world. When you get shut out of SWIFT, you can't make those transactions. So what does that mean? If hypothetically a large Russian bank is involved in transactions, let's say with Banco Santander in Spain, they can't make those transactions. The money is frozen. They can't make those transactions. So they have major counterparty risk here. They're deeply in trouble. Well, the economies and the financial markets are so integrated that if they can't make these transactions, they're effectively shut off from global finance. That's item number two. Item number three, is that the Russians have vast amounts of foreign reserves because they sell so much oil. Russia is, if not the largest, I think they are the largest oil exporting country in the world. And so they have built up a lot of reserves of US dollars, of euros, and other currencies. When you refuse to accept those reserves that they have in transactions with Russia, then they're stuck holding these reserves and they don't do anything for them. So they have this mountain of reserves, but there's nothing they can do with them. They become effectively useless. They do not have any value in transactions. That hurts a lot. So we watch that very carefully. Next, what's happened is that the central banks, mainly the European, the East Asian, and the North American central banks, have coordinated their monetary policies, meaning they're all pretty much going in the same direction. They're all fighting inflation simultaneously, and they're all ignoring transactions with the Russians. So Russia is shut out of any kind of policy coordination. So if Russia should get more inflation, which of course they already have, there's really nothing they can do on an international level to fight that. That's all very, very important. I think for the most part, that's really it. When you shut out their reserves, when you don't let them be involved in the payment and settlement systems, that's what SWIFT is about. When you don't allow them to take part in transactions that could help to solve some of their domestic economic problems like inflation, they really suffer.
And that it seems that also Putin was caught by surprise, and then I'm elaborating a little bit, because we saw the bank run in the first day of this reaction in Russia, where people got worried about, okay, my bank have enough money if we are not cut off? And so what do you think about that in terms of like impact that this sanction are having on their side?
Well, what would typically happen, Giorgio, in a scenario like that is that there would be a run to ATM machines and banks to withdraw money. What happens is that the banks run out of money. The central bank in Russia could create more rubles, but those rubles aren't worth very much because the value of the ruble has dropped already by close to half. So what happens next is the Russian citizens, businesses and individuals will then say, well, if we can't get rubles, what we want are the stable currencies. We want Swiss franc, we want Japanese yen, we want US dollars, we want euros. Well, what happens is that the Russian central bank runs out of those also. And they do not have the ability to get transfers of those kinds of currencies into their economy. So there's no safe haven now for the typical Russian household or business. And now you start to get panic situations because they have no currency that they could lean on. International trade is tough because their currency has lost so much of its value. Anything they import is really expensive. And they can't import from much of the world. They can still from China and India and some other places, but they can't import from much of the world. And anything they do import is going to be at a very low value, is going to be very expensive to them because the ruble has lost its value. So the actions of the central banks around the world has undermined the value of the ruble. That's critically important.
Adi, it is. And I mean, I still cannot justify never, but understand what was the rationale behind this attack from Putin, because I only see negative side. So that what is looking now for the future is like, even when this one is finished, Russia is not going to be part of the global system as it used to. And so everything they import is going to be super expensive, and no one wants the oil from them, or everyone will try to limit their dependency from Russia. So it's so negative that I don't understand what he was thinking or what he was saying in this operation.
Well, without getting into a political discussion, I will just remind you of something from history. And I'm not a great believer that history repeats itself, but a reminder from history would be that the world has a very short memory. And there are two things that are going on in response to your comment, which I happen to agree with. Two things to keep in mind. Number one, he has a couple of safety valves. The Chinese have not signed on to sanctions, and the Chinese have already committed to buying as much gas in particular, but also oil, as Putin wants to sell. So has India. So that's two. The countries with the two largest populations have not signed on to sanctions. That's one aspect. Aspect number two is that eventually things will calm down again, and the world will begin to look at Russia, who knows, 3 years, 5 years, I don't know when, and look at them again and say, there are investment opportunities here again. Russia's a very large country, and some of the sanctions will go away, and the world's memory will fade. And in the meantime, he will have taken over Ukraine and put in his puppet government, giving him access to seaports that he has always wanted, that he has admired. You know, he has always admired, some of the great leaders of the Russian Empire all the way through the 1800s, Peter the Great. And when you look at what he accomplished, he had eyes on places like, which we now call Azerbaijan, with all of its oil. Mm-hmm. But the dilemma that Putin is facing now is that there will be pain inflicted on the people of Russia. He's got a communications campaign, I'll call it a propaganda campaign, where even school children are being taught that this is all about preventing genocide being committed by the Ukrainians, that this is about the threat that NATO had on their borders, so he's protecting the Russian homeland. And by the way, this isn't even a war, it's just a military operation. So the propaganda machine will work, and over time, the world, unfortunately, will have a short memory. That's what history teaches us. Maybe that won't be the case going forward, but Giorgio, the big thing is we have to hope that this doesn't spiral into something bigger.
That's the clearly it's a serious, serious problem or danger that we are currently looking at. Something that we didn't think was even possible 10 days ago. Now we're considering it as a serious risk to reconsider. Yeah, it's a bit of a scary situation to be in. Let's hope for the best, and then politician can find a better solution to another war or bigger war.
Well, this is likely going to end, Giorgio. This is likely to end. I was just talking this morning with my friend Giulio Martini, so it was on my mind. This is likely to end when Putin says it's going to end. In other words, it's over when he says it's over. And I don't imagine that you could bring together a military force as large as he has brought on Ukraine until he has achieved his goal. And his goal is to take Ukraine. Once he has Ukraine, then you could start negotiating, because you have to worry about the threats to Latvia and Estonia and other places that he has his eyes on. But as I said, the important thing is, and the markets understand this, is that market participants and the world in general has a very short memory. And I always keep that in mind when I set up investment strategies.
Yeah. We'll see how it's going to end. But thank you very much for doing for clarifying what the central bank had for. Like always, when I talk to you, I always learn something. So it's very, very useful and interesting. So thank you very much, Steve. I hope I will have you back in this conversation sooner or later.
You're very, very kind. And thank you for the opportunity to do this with you. It really is a pleasure. Thank you.
Thank you, Steve.